All right, let's get right into it. Welcome to the Explainer. I am so glad you're joining us today because we're doing a real deep dive into the mutual fund world. Specifically, we're going to unpack the draft scheme information document for a newly proposed fund, the HDFC Nifty Auto Index Fund. So let's jump right in.
Now, be honest for a second. Have you ever actually tried to sit down and read a mutual fund draft prospectus? If you have, you know exactly the pain I'm talking about. They're just incredibly dense. I mean, they're packed to the brim with financial jargon, endless legal disclaimers, and tables that just go on forever. For the everyday investor, opening one of those PDFs is, well, it's completely intimidating. But honestly, that's exactly why we're doing this today. We're going to take all that complex, heavy document text and translate it into clear, easy-to-digest takeaways. So, this specific fund we're putting under the microscope today comes from a name you definitely know in the Indian financial space, HDFC. We are looking at the HDFC Nifty Auto Index Fund, managed by HDFC Asset Management Company Limited. Keep in mind, this is currently in its draft phase, which basically means it's a proposed new offering that hasn't hit the market just yet. Okay, to keep things moving quickly, here is our roadmap. First, we'll meet the fund. Then we'll look under the hood at asset allocation, decode their derivative strategy, run through the fees and managers, and finally assess the risks. Section 1. Meet the Auto Index Fund, the basics. Right, so the absolute most important word you need to know right off the bat is passive, because this is an index fund. That means you don't have fund managers sitting in some high-rise office trying to manually pick winning auto stocks and dodge the losing ones. Not at all. Instead, this scheme literally just mirrors an existing list of stocks, specifically the Nifty Auto Index, and they look at the total return index. The fund's only job is to replicate that exact basket of auto sector stocks as closely as humanly possible. Now, they are subject to what the industry calls tracking errors, which are just those minor, unavoidable deviations from the index's actual performance. Ultimately, passive replication is the main goal here. But, and this is a big but, with any financial document, there are absolutely no guarantees. The text explicitly points out that there's no assurance the scheme will actually achieve its investment objective. It's a stated goal, sure, but it is definitely not a legally binding promise of performance. Moving to Section 2, looking under the hood, asset allocation. Let's see exactly where they are allowed to put the money. This fund operates inside some very strict boundaries. If we look at the asset allocation limits, a massive chunk, we're talking 95 to 100% of the total assets, must be invested straight into the actual constituents of the Nifty Auto Index. So by design, it's a heavily concentrated portfolio. Now that remaining 0 to 5%, that can be held in plain vanilla debt, liquid schemes, or money market instruments. Basically, just cash equivalents to keep the daily operations running smoothly. But you know, sometimes what they can't buy is just as important as what they can. The document outlines some very strict exclusions. This fund absolutely cannot invest in unlisted debt instruments. They cannot do any short selling, no securitized debt, no credit default swaps, and absolutely no foreign securities like ADRs or GDRs. Unless, of course, they get them through a corporate action or they magically get added to the benchmark index itself. It is a very strictly fenced-in playground. All right, Section 3, the derivative strategy explained. Okay, stick with me here, because this is arguably the most complex part of the scheme document. It states that the fund can take exposure to equity derivatives up to 20% of its net assets. Now, you might be wondering, why do that in a passive fund? Well, it's primarily for portfolio rebalancing and generating returns on what they call idle cash. Think about it. Mutual funds get new cash from investors every single day. And sometimes there's a lag between receiving your cash and actually executing the trade to buy the underlying stocks. Rather than letting your money just sit there doing nothing and potentially missing out on a great market day, they use stock or index futures to immediately get that market exposure. The document actually gives us a really solid mathematical example of how this plays out. Let's walk through it together. Say the scheme holds 50 crore rupees in its underlying equities, but they just got 5 crore rupees in brand new cash today, so they immediately go and buy 5 crore worth of index futures. If the market suddenly jumps up by 10%, that 50 crore equity base gains 5 crore. The 5 crore sitting in futures gains 0.5 crore. Add it all up and the total portfolio gains 5.5 crore. Essentially, the futures made sure that new cash didn't get left behind during the rally. But as with anything in finance, this strategy cuts both ways. Let's look at the downside. If that exact same portfolio hits a 10% market fall, the 50 crore equity base loses 5 crore. And because they held that 5 core in long futures, the derivatives also dropped by 0.5 core. So your total loss is amplified to 5.5 core. By holding those futures, the fund is fully participating in the market's exact movements, for better or worse, even before the actual physical stocks are bought. So if we take a step back and look at the big picture, the ultimate goal of this derivative strategy really isn't reckless gambling. It's just operational efficiency. It's a mechanical tool that the fund managers use to handle the reality of cash flowing in and out every day. It ensures that every single rupee you put in is tracking that market index from day one.
Which brings us to Section 4, Fees, Minimums, and Managers, Rules of the Road. Now let's talk about the practical details of actually investing in this proposed scheme. And honestly, this first number is fantastic if you're a retail investor. 100 rupees. That's it. That is the minimum application amount during the new fund offer period, and it actually stays the minimum on a continuous basis for any extra purchases or switches later on. It is designed to be highly accessible. Here is another number we all love to see: 0. The document specifically outlines a 0% entry load and a 0% exit load. This means the fund isn't slapping a fee on you just to walk through the door, and they aren't going to penalize you when you decide to take your money out. It keeps the friction incredibly low, which is exactly what you want when you're looking at a passive index fund. However, you can never escape all the fees, right? This specific tiny number here, 0.005%, is the government stamp duty levied on the allotment of units. So whether you buy a lump sum, run an SIP, or reinvest your dividends, this tiny little fraction is going straight to the government. And if you transfer units between demat accounts, that stamp duty bumps up just a hair to 0.015%. It is a very small cost, for sure, but it's important to know what's in the fine print. Now, behind the mechanics of every fund are the actual people running it. The key personnel listed here are fund manager Nandita Menezes and co-fund manager Arun Agarwal, both of whom have years of dealing and management experience. But, and this is a really vital reminder, because this is a draft document for a brand new scheme, there is literally no historical performance data yet. There's no past tracking error for us to review, and the actual total expense ratio, the ongoing management fee, isn't set in stone yet. So you are really buying into the structure itself, not a proven track record. Okay, final part, Section 5, Assessing the Risks. It's time for the reality check. The regulatory authorities require every mutual fund to put a visual on their risk level, and here are the official riskometers pulled straight from the draft. The scheme is on the left, the benchmark index is on the right. And what jumps out immediately is that the needle for both of them is pinned firmly in the red zone. What is really interesting is the specific language the regulator, SEBI, uses here. They don't just say risky. They use incredibly precise categories. Notice this isn't moderate risk. It's not even moderately high risk. Both the scheme and the benchmark carry the absolute highest possible label, very high risk. Why? Well, because it's a thematic fund completely, 100% concentrated in a single sector, the auto industry. If the auto sector struggles, your entire investment feels that hit directly. There's no diversification into, say, tech or pharma to cushion the fall. And to track how that risk actually plays out on a daily basis, you need to understand the net asset value, or NAV. It's essentially the fund's daily report card. At the close of every business day, the fund takes the total market value of all the auto stocks it holds, adds any current cash assets, subtracts whatever liabilities and provisions it owes, and then divides that total pie by the number of units outstanding. That simple formula gives you the exact per unit price for that specific day. And that brings us to the end of our deep dive into the HDFC Nifty Auto Index Fund draft document. We've gone through the passive strategy, the strict allocations, the way they use futures to handle liquidity, and, of course, that bold red, very high-risk label. So I want to leave you with one final provocative thought. Given that intense, narrow focus purely on the auto sector, how might a targeted high-risk index fund like this actually fit into your own personal financial journey? Does it complement a widely diversified portfolio you already have, or is it just a bit too concentrated for your comfort zone? It's a critical question every investor should ask before taking the plunge. Thank you so much for joining me on this explainer, and keep learning.